The broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody. How are we doing? We're going to give it a couple of minutes and then we'll. Hi there. Welcome to VXX Made Easy, the Option Pit Easy Series VXX. This is part one. This is should be a lot. We should have a lot of fun today and learn some stuff. So before we begin, let me remind everybody this is for educational purposes only. Should not be used as or considered investment advice. Options have a risk. Now, I want, I'm joined by Andrew Giovinazzi. We're going to take about 2 seconds to introduce ourselves. Most of you should probably know me. If you don't, my name is Mark Sebastian. I'm the founder of Option Pit. I was a floor trader for about 10 years. And then after that, I founded Option Pit. We are an education and consulting company. We work with traders to teach them the same way I was taught. So like I was taught by a trader to become a trader. And now you guys get that. And so when I kind of left the floor, I realized there was nobody really teaching people how to think like a professional. And I think that's what we do differently. In addition, I am the Chief Investment Officer at Carmen Line Capital. We have 2 funds that we run for accredited investors only. And again, I am joined by Andrew Giovinazzi. And Andrew, you want to tell everybody a little bit about yourself?
Sure. I work at Option Pit now. I've worked with Mark for 6 years. And I run a lot of the education stuff and a lot of the individual mentoring as well. So a lot of the teaching. I do the Platinum Series, the Pro Series. I help clients design trading plans and trading routines from a risk managed point of view. I also help Mark with the funds. I do the risk management side of the fund. And with this, I help them create a lot of our educational products. I was a floor trader for 15 years. I was leaving Group 1 as Mark was starting when I started my own thing. So that's what I came over here. I'm like, wow, this looks very familiar, this trading volatility stuff. I could have sworn I've done this before. And Mark said, yes. That's what we do here. So our take on trading options has a volatility bent because that's what we learned to do. And now we have transported that to the volatility products, which didn't exist when I was a floor trader. I'm that old, but
yeah,
heck, you can learn.
Yeah, it's a lot of taking professional approaches to what the retail public is trying to do. All right, so here's what we're going to cover. What is volatility? We're going to talk about January 16, 2018, and we'll talk about why that's an important date and what that taught us and what it was hinting at. We're going to walk through what VXX is, what makes it move, and some ideas on how to be profitable. So to start, what is volatility? And yes, that is someone that has a volatile personality. That is something, but that is also not what we trade here. So volatility is simply a measure of an underlying movement or lack of movement. So the S&P was up 25 points today. That would be measured as a volatility, how much it moved today. For stocks, ETFs, indexes, futures, a lot of times we measure close to close. There are other ways to do it, but most people look at close to close, and then we call that historical or realized volatility, and that's just how much is something moving every day. Here's how much it moved yesterday. Here's how much it moved today. If you want to see the S&P 500 index, the white line is 10 days of movement. The light blue line is 30 days of movement. And what they're doing is basically looking backwards at what has happened the last 10 days. So in this case, if we looked at today, over the last 10 days, the S&P has moved about 10% a day. over the last 30 days, this light blue line, the S&P has moved on an annualized basis 15%, or 16%. So this is an annualized number. We're taking 10 days of data and annualizing it. And that is really just what historical volatility is. It's a backward look at how much things have been moving. We sometimes call realized volatility, kind of the shorter dated historical volatility, what's happening now. But really, every move, if you think about it, is historical, except for future movement. And if you know future movement, then you shouldn't be here. It'd be pretty impressive.
It'd be hugely impressive.
Yes, it would be amazingly the thing. All right, so now what is implied volatility? All right, what is implied volatility? Well, just in brief, options use what's called a pricing model. And that pricing model wants to use 5 factors in it. It wants to use price of the underlying, the strike price, the stock price, the stock price, the strike price. So Apple's trading 190. The strike price, the 190 call or put. Timed expiration, May options, June options, whatever. Cost of carry, so that's dividends, a little bit of interest rates are in there. And then the way the modeling is written, it wants to use forward volatility. Well, as Andrew and I just said, if you can get what the future movement is, then call me, because you don't belong here. And really future volatility, forward volatility, we don't know. So what we do is we actually take the price of the option and the 4 things that we do know and solve for it, solve for forward volatility, and that is implied volatility. All right, so what VIX measures, the VIX, and this is what VXX is all based on, is implied volatility. It uses 30 days of implied volatility. Why 30 days? Well, when they first started with VIX, they only had monthly options. There were no weeklies. And really what it's, the professionals that use it, that's kind of what they want. It was kind of market driven. And so the calendar is something that we have to pay attention to when we're trading VIX. Most importantly, this is important, VIX doesn't measure IV of options expiring this week or next. Now, it tangentially does because all options are related, but really it's only looking at options with 23 to 37 days to expire. You're looking a month out. So today the VIX had 30 days to expire. Tomorrow the VIX will have 30 days to expire, and so on. And what it's measuring is implied volatility of options on the SPX with 23 to 37 days to expire. And it is telling us what is the demand for protection, right? Options are protection. What is the demand for protection? Pretty simple. And here is the VIX. And Andrew, why don't you kind of tell everybody what we're looking at here?
What we're looking at is there's many volatilities here, right? So this was a snap from probably 6 months ago or something like that, where if you look at,
I'm going to go out on a limb and say the snap is sometime around October 9th or 10th.
It's not in September, so this is this was a weekly option here, the October 11 SPX weekly. So VIX actually looks at the option sort of, well, think of it to the right of the screen, right? So you're looking at the 10th if that was a trading day, and then you move to the right a little bit more. So it's looking for something just somewhere in early November. But what you notice is that each term has a different volatility. Each weekly has a different volatility, which we call the sigma, right? You could almost think of, wow, look at that line, right? Mark just drew that. That's pretty cool. You could you could think of that as each weekly volatility has a unique price. When you look up, this is a live vol screen, for instance. On the upper left, you see the IV30. That's 30-day average volatility. So the way live vol calculates this is they look at the money vol, the 3 strikes above the money, the 3 strikes below the money, and they average. So they were seeing only a 7.6 volatility looking 30 days forward when we were in early October, which I believe is probably the lowest print ever for IV30. And that is what, and those numbers are the things that drive VIX. So
yeah, the
volatility can be...
The lowest print ever for VIX was December expiration when it printed like 880 or something like that, 875.
Ridiculously low.
It was ridiculously low, but yeah, you can see, assuming this is, either October 8th or October 11th, you're kind of looking at, around, some options over here. Not even the October 30s would be there. So you're actually looking at November when it's October, when you're looking at VIX.
So that's what a lot of your decisions have to be based on if you're going to trade it. Or you trade anything remotely related to VIX, a lot of the decision making is not what the volatility is doing in the very short term. It's how the market is going to change its opinion in the longer term. I mean longer term as in 30 days from now.
And Andrew, you can keep walking through this. Here's how kind of the VIX. So now that we've kind of talked about the VIX itself, because you can't really trade the VIX, all right? There's no tradable VIX. It looks at so many options. They developed the VIX future, which is a forward contract on the VIX index, cash settled, and the VIX futures assume mean reversion. And so if you're assuming mean reversion when volatility is low, what do you think is going to which direction would VIX revert? What about when it's high? Which direction would it revert? What do you think?
Can I guess?
Well, you know the answer, but yes, feel free.
Is anybody else going to guess? Hold on, wait. I was waiting for a guess. I think all their fingers are stuck. Their fingers are stuck to their keyboard. They can't guess. I'm not seeing any. Okay. Richard says 15s. Mean.
Yeah. Well, no. I mean, so when the mean is low, the futures will trade at a premium because they're assuming that volatility will increase, and when VIX is really high, they'll trade at a discount because the assumption is the VIX is going to drop. And, that is why that's the case. Is around 20 the long-term mean? Well, most people more consider 17 closer to the long-term mean than 20. That 20 number as time has passed. Actually, the VIX number. You know what handle VIX trades with the most often. So since since they went to the new model in 2003, right?
Was this the mode?
Yeah. What is VIX's most common number? You will be surprised.
Like 15 or 14 or something like that?
It's lower.
Like 13?
Lower.
12?
Yes, it's 12.
It's not a 12. That's pretty low.
Yeah, so more often than not, the VIX has a 12 handle than any other integer, meaning it's somewhere between 12 and 12.99. All right, so Andrew, why don't you talk a little bit about what people are looking at here?
Okay. So far, I have not understood anything that has been said.
Well,
I just saw that's the thing.
Well, here's what I would say.
Then you should take the class.
Yeah, here's what I would say is, if you've not understood anything that has been said, then stick around because we'll teach you we'll show you what you're going to get to understand. All right.
So what I think is kind of
Andrew, explain what they're looking at.
So Mark and I sat around one day and we're like, okay, how the heck do we explain the vol futures to people, right? We might have had a glass of wine or two or something like that, possibly. But like, well, why don't we just think of, where the futures have to go? So what's important when you trade VIX is what Mark said is you can't trade VIX, can't trade the cash, but you can trade the futures. And almost everything in the VIX volatility complex as a vol product trades around the futures. So we have to figure out how those futures are priced and where they're going. So the concept we came up with is gravity. Where does that future have to go? So right now on this chart, you see a 1455 VIX cash, right? And you see the future at the May future was 1565, 1617, 1616, all the way up and up and up, right? So the thing is those futures over time are going to drift toward, he says, what do you mean by the VIX cash? So I refer to that 1455 number as the VIX cash, Rick.
Yes, the VIX cash or the VIX index. They can be used interchangeably. The VIX cash is maybe a little industry speak for just the VIX index.
Right. There's a question about is there a VIX for oil, gold, and bonds? There is. We're not going to cover that today, though.
Yes, there is one. Oil is OVX, gold is GVZ, bonds is TYX.
So what happens is if you want to trade any kind of VIX product, you need to know where those futures are going. So we developed a method to help you come up with how accurate those future prices are, trying to come up with a fair value versus where the VIX is. So part of the rest of VXX Made Easy, right, is you actually start to understand how these futures are supposed to perform. And when they're not doing what they're supposed to, that's when we think, and we have a little bit of hard evidence to back that up, when this is really when you want to look at the futures. When is there really a trade? Because you understand expected action. Like when this future curve is like this, I assume something's going to happen every day, and that's what I bet on. Now, we're on to the next slide. Do you want to talk about this slide a little bit, Mark? Or
no, I mean, so one of the things we talked about, one of the things that we think is really fascinating is how if you use SPX and VXX, and you can actually start to get insight into when the market is going to have a correction or when there's going to be a big sell-off. And so what I asked Andrew to do, because we both saw this coming, is walk through kind of January 2018 and why everybody was so alarmed at what was happening. So, and I like that you used Danger Will Robinson from the old show as opposed to the brand new Lost in Space that they just released on Netflix. I've been watching that. It's pretty good, actually, Andrew.
I've been watching it with my kids.
Yeah, I kind of like it.
Have we explained what VXX is? No, not yet, John.
No, we will get there.
The problem is if I just say what VXX is, then you're going to say, then what's VIX or what's volatility? So we got to give you an idea that these things exist before we can talk about VXX. So this is, I looked at this and I go, well, there's a couple things that were strange that were happening. So if you look at the chart on the left, that's the SPX January in the run up to that really huge in that run up to the huge rally that we had. So do you guys notice if you look at the bottom, the little yellow line on the lower left, that implied volatility was going up at the same time. So normally what happens is that as the market rallies, and there's a lot of just mathematical reasons for this, but for the most part, as the market rallies, like you've seen over the last couple days, if you watch volatility at all, as vol goes up, or as the market SPX goes up, vol should go down. The exact opposite was happening, where SPX was going up and volatility was going up. So that was kind of, again, for people that followed our vol newsletter, we had a lot of good trades for that situation. But it was definitely not normal, okay? The next thing is VXX. So normally when the SPX goes up, the correlation is that SPX and VXX, the product, which we'll talk about in a couple seconds, goes down. And you notice what happens
like,
too
look
is
at today, we had a big update in the SPX and the VXX was down
crushed.
almost 5%. And
Right.
S&P was up 1.
That is kind of what I would say normal, right? The normal action for VXX. But if you look at how VXX performed there, Mark drew the two little red arrows. That would be the chart on the upper right. You know, VXX was very flat during the rally in SPX and then started to rally kind of hard even when SPX was rallying. So it was a really odd thing, very, very odd. Also, what was happening was the implied volatility, that is the volatility of the options in VXX, the 30-day vol.
That's right, the red line down here, folks.
The red line down there for VXX was also kind of increasing. It wasn't going down. It should be being smeared. Again, that's something we talk about in the VXX Made Easy overall. But those are two important trends that should be working together. And anytime things are not going like they should be, that's the market is kind of screaming danger, 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 right? With rising IV into a historic rally, that's usually something's up, okay? If you look at the action today, for instance, you would see the exact opposite. We have a pretty decent rally, and they just obliterate volatility. That's mathematically what's supposed to happen. Now, on to January 16th. I just showed you the future chart a couple of slides ago, right? Where I said, hey, here are these futures. Here's the VIX cash, right, where the index is right now. And the idea, what Mark was explaining here, is this gravity thing that these futures are supposed to drift down to some cash level. Here, okay, do you notice how the futures are very close to the VIX cash? The VIX cash on the close on the 16th was 1166. The future expiring the next day was 1177, which that's not unnormal, out of the ordinary. But the 30-day future was only 1207. So the VIX cash in that future was very close, right? They're very close together. But think about it. The future is supposed to be a 30-day product, right? That means you're buying 30 days worth of time. And in this particular case, it's costing you only 41 cents to buy 30 days worth of time. Now, if you scroll back like two ago, do you see how much 30 days worth of time costs now? More like in this slide, even a couple days ago, it's now $2. But here it was more like $1.50. So why is it that in this graphic, time is worth $1.50? It's the same 30 days basically, and in here that time was only worth 41 cents. So considering the dollars that are involved for 30 days worth of time, this is a massive difference, right? So when we teach trading volatility, the vol products, the vol futures, all the stuff that's in VXX Made Easy, we teach you how to read these charts, to understand where things should be, where they need to go, and what you need to do to position, because things are supposed to act a certain way, and when they're not, you want to know. Okay, so in this case, I say, like, where's the beef? I don't know if I'm pretty old, so I remember this ad when I was in high school. Mark was probably 2 or something like that. But
we were talking about this the other day, weren't we? It
yes.
was Wendy's. I was looking.
It was Wendy's, yeah.
Yeah. No, I remember that. I was like 6 and 7 when those commercials were out.
So you were in Burger World back then.
Yeah. So
the idea is there's no beef in the future, and there should be.
It's the home of
when
Big
there's
Blood.
not. So when there's not any beef in the future, that's when we care. So from a trading point of view, you position differently when that happens. Okay? So here's a couple things. January 16th breakdown. This is, again, going through things methodically in a list in a way that you can repeat. The day before Jan expiration, in this case, the VIX future, the VIX cash got too close to the longer term futures for too long, meaning there was no premium in there. That, to me, at least the way Mark and I look at it, that's a signal that something's up in the market that nobody quite understands. Okay, SPX was not in sync with VIX. Since your implied volatility keep rising, it shouldn't do that. Mathematically, as SPX rallies, VIX should fall. Again, that's something you'll learn about in our VXX Made Easy class a little bit, just how that's supposed to work. There was VIX in contango, meaning those futures were a little bit more expensive, but it was very, very, very small. So the market's still expecting more vol, but they weren't charging anything for it, which usually is a very, very odd thing. So imagine this. You're selling, like in the Wendy's commercial, you're selling hamburgers. Normally you sell them for $2.50, but today, you know what? I'm only going to sell them for $1, or I'm going to sell them for $1.50, right? Something's not right when you want to do that. There's something up that nobody quite understands, because remember, these are market forces. So the fact that things are happening that shouldn't happen, as a trader, that's what you care about looking at VXX, VIX, and the vol products. So these are all usually what I just call danger signs for higher realized vol. Right, so that's the breakdown of January 16th. It's signaling things were happening. So now when you go back and look at the SPX, right, this is volatility as it appeared at the time, where we had extremely low volatility for a very long period of time. Okay, so there's a question that AJ asks, how the VIX behaves in future backwardation. The VIX is hugely volatile in future backwardation. Literally, it can be anything.
Yeah. So yes, when the VIX is backward, volatility, that basically says that the market is on tilt, and that volatility is extremely high, and volatility will be extremely high. The VIX will run around, but you tend to see kind of a lot of way out of the money trades, and also a lot of people looking for mean reversion. So it can be that can be an extremely confusing time to trade VIX and VIX products.
So here, this is an example, again, now going back to volatility again. The numbers for volatility, these are very, very, very low volatility numbers, right? Very close to historic lows for volatility. If you looked at what's trading now, all the numbers are much higher than this. But again, the same idea, you think about it, we were trading 2,500 and the VIX is 7%. So the whole idea of this as a concept is the volatility kind of has this range, right? It doesn't really matter where SPX is, but the volatility has a range. All of that stuff is tradable, at least the way that we think about it. And if you want to trade the volatility products like VXX, you have to understand how it works, okay? But you have to understand SPX volatility and how that works before you can trade a product like VXX. Because what happens in SPX matters to VXX. How close was Jan 18 to the date that one or two ETNs left? It was 2.5 weeks away, Alan. He's asking how close was the Jan 18
they blew up on February 5th.
2.5 weeks away.
Yeah, they blew up on February 5th. But you could actually see the market starting to melt down well before. One of our funds that we run has a proprietary hedging and issue, and it was long. It was starting to fire long 2 days before, long volatility 2 days before everything fell apart. So pretty fascinating stuff. All right, so let's talk about the trail of the VIX here, Andrew.
So what is a volatility ETP, right? Those are instruments that buy VIX futures. So somebody asked me, have we talked about VXX yet? And the answer is, to understand VXX, VXX buys VIX futures. So the thing is, if you're going to trade options on VXX, those are options on an ETP that owns VIX futures, that price off the VIX index, that price off S&P 500 volatility, that price off the realized vol of the SPX. I always find that funny. 1, 2, 3. So the actual movement of VXX and the VXX options is about 4 or 5 steps removed from the initial catalyst. The thing is, though, is all of this is easy to work out mathematically. All the relationships on all this stuff is easy to work out mathematically. And all we really care about is when they look weird, when they look out of sync, when things are not moving what we would say that we'll call like mathematically normal. So the whole idea of looking for edge, and the reason why we launched the Vol newsletter, the fund and everything else, is every time things look out of sync, that's when we care. When things are kind of normal, and where all those relationships are sort of stacked up and normal, we don't care that much. It's not that interesting of a trade. But as soon as the volatility gets interesting, when vol goes up and the SPX goes up, that does things to all of these products. It makes them do things. It makes them price in different ways. It makes the risk reward payout price in different ways. All really interesting stuff and stuff that's really profitable. So even if you never trade the VIX or the VXX or anything like that, if you understand how these products work, it could help you trading, let's say, an iron condor. You're like, well, all of a sudden this stuff is getting a little bit crazy. I'm just going to close my iron condors. Things are too nutty. And if things start to get normal again, then I'll look at them again. So all of this is really helpful in learning about market signals in general. But the signals that volatility generate are probably the most useful vol signals that you can find. The thing is you got to learn them. Nobody is just jumping up and down on CNBC telling you about these things. All they're doing is saying the VIX is 22.3 today. The fear index is higher. There's no insight into what that is relative to all of these little functions in the trail of the VIX. So that you can learn. The thing is most of the time, people just don't want to take the time to learn it. Okay? So if you want to learn how these products trade, you start with, realized vol in the S&P 500. Okay, that translates to the options at certain times. Okay, index volatility in the S&P 500 is expressed through the VIX cash. The futures then trade on the VIX index. The impression of VIX. From there, you can price VIX options. There could be a potential trade. The second part is the VIX ETPs all follow that VIX future. So a VIX ETP would be VXX. So to get to VXX, with that early question, have we talked about VXX yet? In order to really understand what I would say in a useful way, is you have to follow the volatility from the beginning to the end to get the real expression of what's possible. I mean, just to say that VXX is going to go down tomorrow, right? I would say right now that VXX is very likely to go down tomorrow. Okay, just the way things are set up. Okay, stuff in our vol newsletter wants it to go down tomorrow. Okay, doesn't mean that anything can happen, but it is because of all of these things in front of it that makes me say that. So question here at the end, please brief us on what really happened for the VIX short blow up. Mark can talk about that a little bit at the end. But that's how, if you want to trade these products, that's how you have to think about this. If you don't, you're going to have trouble. Now here, do you want to talk about the VXX a little, Mark? Or?
You are on such a roll, I will let you have at it.
Okay. So anyway,
I'll chime in if you don't say something profound, but they don't call him the mystic of Maine for no reason, guys.
I like the mystic of Maine. I like it. So VXX, notice a couple things about it, right? It tends to trend. Why do we like it as a product? It buys a bunch of futures, right? It basically just buys VIX futures. That's all it does. It buys the first two term futures. So if you go back right now, it owns May and June futures, May and June VIX futures. So the value of the fund of this note is dependent on those things. Notice though how it likes to trend. Do you guys see this really long trend down at the end of last year? What makes the product fun usually anyway, is that it really, once it gets into trend, a vol trend, it stays there because it's riding those futures. Then all of a sudden, kaboom, anything can happen with the vol futures. So what we did see in this case is massive explosion of volatility, which happened. Now for VXX, that's great. It owns futures. So the value of this product went from the mid-20s, I would say, mid to low 20s, all the way up into the high 50s. So now that's a pretty good thing. Now remember what Mark said earlier, it's a reverting product. So can VXX stay in the mid-50s forever? Can it keep staying up there? Remember, it buys futures. All this product does is it buys futures voraciously every day. It sells what it owns and buys some of the farther term stuff every day. So the performance of this product, there are ways you can model and predict it, which is what we're going to teach you how to do. You're right, Rick is saying it's not likely, and it does not stay that high. The actual performance of this product long term is not very good.
Yes. So let's go through some VXX facts.
What?
Know your facts. You can't know what you can't see.
So VXX buys VIX futures and holds them as an asset. Okay, VXX buys stuff that decays.
So
that's number one thing.
The thing to remember with VXX is that it's a, VIX is a index of options with 30 days to expire. Well, it would make sense to have an ETF that is trying to be a 30-day future. So VXX always holds a VIX futures portfolio that always has 30 days to expire.
It's Vega weighted.
Yes, so VXX always has 30 days to expire, just like the VIX. So when so for right now, the May future has 6 days, the June future has 36 days, so it's carrying about 20% May futures and about 80% June futures to have a basket of futures that has a duration of 30 days. That's an important thing. But, obviously that creates some problems. Sorry, didn't mean to interrupt, but it's an important thing to be aware of.
It is. But it makes it interesting to trade. A couple of facts, though. They can change the rules on it, like SPXY and UVXY. It's possible. So far, they have not. And I'm guessing from the backlash that they're not going to.
Yeah, they would have to do that with the new bond, with a new credit issuance for VXX. VIXI could definitely do that. So there is a VXX2 that is or VXXB that is the new VXX, because VXX expires at the end of the year. Credit is related to.
Yeah, Jan 2019. Remember, VXX does not buy cash, it buys futures. So in red, anytime I put something in red on a slide, you should remember it. You need to learn to price fix futures to trade VXX well. It has a 200-page prospectus. Feel free to read it. After trading it long enough, I kind of understand how it works. I have read the prospectus and all the stuff and how things work with the product. So what I've come to the conclusion is it goes out of business slowly but moves up fast. So
and you see Wells Fargo's that some uneducated advisors were using VXX to hedge their client's portfolio, and Wells Fargo just had to do a big settlement with a bunch of people that lost money because
really?
Yeah, because this was put into their portfolio. And you know, it's embarrassing.
They didn't read the prospectus. They could have taken our class,
so,
right? And they could have looked at this right? VXX goes out of business slowly.
Yeah, here, let me show you this real quickly, folks.
Ooh, a nice long-term chart.
Yeah. Come on. So here's a chart of VXX. Right? Looks great, right?
I didn't know there was a Bing chart. Oh, this is Google. Okay, sorry.
Here. Let's pull it up on Yahoo Finance. Come on. And what I'm going to do, I don't care about your privacy policy.
You don't care about your privates?
Performance from today. All right. Here's the 1 year performance. So you can see, has not done that bad over the last year. Now, what about the 5 year? Well, it was split adjusted about $1,200 5 years ago. And then what about the max? So split adjusted on January 26, 2009, the VXX was $107,000. Not so hot, folks.
So, like I said, it goes out of business slowly, but it can move up fast.
Yes.
Okay. So, what it does is, now this is something you can check out as well, is what it buys is predictable, meaning it is like a machine. It just buys the June future right now and slowly sells out its May holdings.
It is the VIX futures equivalent of the machine that is Andrew chopping wood. You guys should see Andrew started chopping wood over the winter. You should see his pipes. It's insane. He looks like Paul Bunyan. If Paul Bunyan was an Italian guy, it would be
6'3", it would be me. So what they do is they buy and sell that 2 front month ordinary future. So what it does is it does create some predictable, let's just say predictable pricing patterns. So just like we showed you early in the presentation, it should be doing something. Okay? Like the stock market inverse, which goes up slowly and down quickly. That's exactly it, Bill Unknown. So this has, the thing is sometimes the product is poised to move very, very quickly, which of course that's what you're interested in. If you're an option buyer, like if you like to buy calls or puts or anything like that, you want to know when it has a shot to move faster. So that's what we kind of built our course around, teaching you how to do that. Right. So here again, now we go back to now looking at this from this way. Everything you see here, that future curve where you see 1565, 1617, 1660, the future, the VXX buys those futures, but gravity, right? Those are the futures going down to the cash because that's where a future has to settle the cash. pulls it down. So right now, the weight for VXX is definitely on the downside. It's slowly going to move down. Now, what you'll do is you'll learn the kind of speed, the velocity of how it moves down, which could be an interesting trade. So anything that has the performance that this thing has, meaning long term it just goes to zero, you know there's a pull in one direction. So anytime you know something is more likely to go in one direction or another, you kind of want to know what that is. So that's what you learn in our VXX Made Easy course, how to help figure this out. So in the course, you will learn this.
All right. The Jan 2016 market was a great signal using the option pit method. Okay. So this is actually what you're going to cover in the course. So let me talk about that some. Well, I'll let Andrew expand, but first let me get to. Let's discuss this first, and then I will.
Okay.
And then I'll hit what's actually in the course, because there's some good stuff here. So just kind of to remind you about VXX, understand the volatility that drives VXX is a part of the puzzle. All right. Trading VXX options successfully depends on the VIX cash in the futures, the IV in VXX, kind of what the future contango and backwardation looks like. And, what is the real edge there? And if you can take the pieces that we showed you, all right, where is VIX cash and futures? How expensive are VXX options? And what is kind of the daily decay? That is where you can develop a trade that has edge in it. And any of those will help epitomize a VXX trade for a given week. And after I talk here, maybe we'll tell you what we did today when we did some math. So, the Option Pit Easy series, starring VXX. We already did our lesson 1 in the Easy series was VIX. That was a few months back. People really liked it. Here's lesson 2. This is the Options Pits Easy series on VXX. So there is a lot of money to be made trading VXX and the other VIX ETPs and ETNs. If you want to learn to trade volatility, this course is an absolute must. You have to take it. All right. And what we're going to do is we're going to light the path of the VIX to predict VXX moves. We're going to walk you through that. We're going to execute VXX trades at the absolute best times. You want to know when is the best time? When do you have the most edge in your trade? That's what we're going to teach you. You're going to master when to go long and when to go short. There are times to go long VXX. There are times to go short. All right. We know when. We don't know, like, we're not like Nostradamus, but we're pretty good at kind of teaching you the best and worst times. And then we're going to walk you through the cousins of VXX, UVXY and SVXY, and any other really interesting vol products that are out there. So if you sign up before the 18th, which is a week from tomorrow, I'm going to give you 1 month of Andrew's Volatility newsletter. The Volatility newsletter has a killer track record. Andrew, what's your win percentage right now?
11 wins and 3 losses since we launched it in February, like literally when the vol blew up.
So you've got an 80% win rate.
When the vol blew up.
Yeah. What have your wins made? What have your losses made? What's your average win amount?
The average win amount is probably around $400. The average loss amount, unfortunately it's a little skewed because one position was twice as big as everything else. So I've had one loss of $300, one loss of $50, and one loss of $2,000. But the $2,000 trade was 3 times the capital of everything else. So we've right-sized the capital since then.
So $4,400 minus $2,350, and that's $2,000. What's the margin that your average margin?
Oh, right now we're only using about $1,500 in margin total.
So in 2 months using
we've dropped it a lot.
using $1,500 of margin, you've returned 136%.
Yeah, something like that. Yep.
Yeah, you know what? I think that's you know, I'll buy that for $1. I'll tell you that much.
And I have all the results too. It's in a spreadsheet. We open and close everything. Send out email alerts.
Yeah. So here's what you get with the Vol newsletter. You get 1 to 2 good trading ideas a week with alerts telling you when he's getting in and out of his trade, and then a weekly meeting to ask him questions and walk through what's been happening. Then and email support and things like that. It's really, that is worth more. That'll pay for what this course is going to cost. Then now, if you sign up by tomorrow, and all right, so by tomorrow, end of day on Friday, we did a 5-part VIX Made Easy series that we charge $297 for in our store, and I will give it to you for free. So you're getting a month of the Volatility newsletter and a $300 course, plus you're getting the 5-part VXX Made Easy series, which is also a $300 course. So what we're talking about, it amounts to, let's call it $800 worth of material, and I'm going to let you sign up for $197. $197. And that's if you sign up by tomorrow. Go to the website down here. You can see it right here. I'll post it in here in the chat. It's right there, folks. And you'll get an email with how to get that. And so the big thing to be aware of is that, this is going to be the best deal that we give on this. And, if you go through the course, you take 1 or 2 and you don't like it, we'll give you your money back. If you know any coupons, feel free to apply them. But yeah, if you want the VIX Made Easy course, you need to sign up by tomorrow. And it's for $197. It's a steal.
It's a good deal.
It's a great deal. All right. Do we have any questions? Do we have any questions? Other than, can you make your baby? Mark, is this covering your book, Trading Options for Edge? No.
No.
Now, Trading Options for Edge is a great book. I think it's the best option book that I've ever written. And it's really, really good. You should buy it. But I get into a lot of, I think the thought process behind how we teach the course is in the book. But what we really go through is pretty interesting. Alex, shoot me an email and I'll give you a call. What is the additional cost for people already part of the VIX Made Easy? What is the additional cost? Bill, shoot us an email tomorrow. Please brief us on what really happened in the VIX short blow-up. What happened was XIV ate itself. It is a very long story. Do you trade VXX options, spreads, or calls? But I trade the options a lot. So a trade we did today, you won't be able to see this, but a trade we did today is on the open when we were kind of looking at VXX. We did, I think you'll like this. We bought the
the link isn't working, Mark.
And we bought the June. It's too late to do this now, so I don't mind talking about it. We bought 150 of the June 35 puts, and against that, bought 200 of the 40-45 call spreads. and we did that for a debit of $202.20 as if won. So, and as if won means if we did this 200, we would have paid $220, and you can see that spread is $2.67 now. It was a really nice trade that we did. That is yes. But anyway, XIV ate itself. At the end of the day, they began entering their end of day book. They had a lot of options to buy, and rather than just slowly buy them, they put it in the what's called the TAS book, and they built up more and more and more and more and more, and basically by being borderline lazy, pretty lazy, and you could use some stronger words there, they blew up the fund, and that caused everything else to blow up. All right, now it's 5 o'clock. No more questions. If you want to really learn about a lot of this stuff, then you got to buy. I'll take questions about the course, but if you really want to learn this stuff, you got to sign up for the. You got to sign up right here.
If you just sign up for the free course, do you get the right link?
Oh, this is the wrong link. 1 second here, folks. I'll get the right link. Andrew, why don't you tell everybody one more thing about how great you are?
I could switch presenters if you want, but the idea with our vol newsletter and our trading is we're looking for edge in our positions. Anytime we can find some edge, that's when we put a trade on. So the idea is we teach you to trade, look for edge first,
There it is.
and then put the trade on after. Is it true that out of the money has less IV than? Yes, that is true, Bill.
So
what was the edge for today's trade?
Oh yeah, why don't you? That's a good question.
Edge for today's
if you want to know what the edge was in today's trade, you got to take. You'll need to take the course. Sorry, folks. That is some secret sauce that we're giving away there. But here's what I'll tell you. Here's what I'll hint at is, Andrew talked about how, you can look at what the construction is of VXX and do some math around that to construct trades. So what I would tell you is we did some math to construct, looking at, what was in VXX today. And we constructed a trade that we like out of that. Does that make sense?
It does to me. What's the where's the other link?
I'm getting it up.
Oh, okay.
Things are really slow for some reason right now.
Because you want it.
Yes, that's exactly what it is.
Did she say because you're Mark? I can't even get into Infusionsoft right now.
Oh, lovely. Andrew, it's that VXX landing page on the member site.
Okay, I'm looking for it right now. Hold on here.
Mark.
So I'm trying to get it, and there's a thing, the new series VXX, but it's not letting me get to it. Hold on here.
I'm almost in. All right, I'm in. I got it.
All right.
Here we go. That's the one I wanted. There's my Huckleberry. Here's the link, everybody. Sorry about that. Here's the correct link. And, you know, at the top is the sign up for the webinar. But then if you scroll down, you can sign up for the series itself. There you have it, folks. And you can see a video of me of Kramer telling everybody how smart I am.
VXX Easy. Okay, easier.
Yeah, it's the VXX Easy Series details. So there you have it, folks. Sorry about the delay there, but if you want to, this is actually where the replay of today's webinar is going to be as well. So be on the lookout. All right, everybody. I want to thank everybody for coming. Andrew, I'm going to stop recording and I'm going to mute myself. But if you want to, here is the link.
There it is. Why couldn't I get to that?
All right, and I'm going to stop recording and mute myself. But if anybody has any questions about the course, Andrew will answer them. Otherwise, I hope everybody has a great evening.